I'm here today with Tim Price, investment manager and editor of the Price Report, which some of our readers will know. We're going to talk generally about the market and about Tim's investment philosophy. But I want to start, Tim, by asking you about the financial world in general. There's a view that since the crisis, things have begun to normalise and we're getting into a more regular environment. But I suspect you're not really of that view.
No, I'm afraid I don't really buy that. McKinsey, the McKinsey Global Institute recently pointed out that far from this being an environment where you've had a slow and gradual and easy deleveraging, actually there's just more debt being added. So I think by their figures, 57 trillion more has been issued since 2007, 2008. We're living in a completely dysfunctional market environment. Probably the metaphor that everybody's used is that of cans being kicked down the road. Extend, pretend, nothing's being fixed.
So as far as you're concerned, the debt problem that we had in 2007 remains
worse.
Entirely with us, and it's just got slightly worse.
Well, not worse to the extent that people now look at bond yields being abnormally low, all-time low historic yields, or in many cases, I think there are at least 5 countries in Europe now that have negative, in the Eurozone, that have negative bond yields. Who in their wildest dreams would have thought you could have negative yields full stop? But we've got that. I think every Bund yield in Germany is now negative out to 7 years.
And can you just explain for readers who don't necessarily work in this world what it means to have a negative bond yield? It
means you're paying money to lend money to the government. It's worse than having a bank account that you're being charged 0.5% or 1% on. If you hold those bonds to term, because buying a bond is simply lending money to someone. It's just an IOU. If you're buying a bond with a negative yield, you are guaranteeing that if you hold that loan to maturity, you're going to end up losing money. It makes no economic sense whatsoever.
Why on earth would somebody do this? Why would an investor go out and buy a bond with a negative yield when they could just keep the money?
Well, that's a perfectly legitimate question. One answer is that you've got the biggest buyer in the world who's already pre-announced he's going to be buying 60 billion euros a month of this trash, and that's Mario Draghi at the ECB. So effectively, institutions in Europe are, you could argue, being sensible in that they're simply front-running the European Central Bank, because they're going to be out in the market buying this rubbish up.
The point being that will make the yield even more negative.
They'll be buying it at an even higher price and even lower negative yield.
So it's a greater fool environment with the greater fool already pre-announced.
Being Mario Draghi. Another possible answer is that you've got a lot of institutional investors, pension funds specifically, they've got no real choice but to buy this stuff. A typical pension fund, its liabilities paying out future pensioners, the only thing that the authorities deem an appropriate asset to match those liabilities is the so-called risk-free asset known as government bonds. So there are a number of reasons why this market's dysfunctional, but it clearly, for those investors for whom they have a choice, it doesn't make any sense to be buying this rubbish.
So what does it make sense for people who don't have to buy bonds to buy in an environment like this?
I think that's a very good question, and it's a very tricky question to answer, in that people are looking for, quite reasonably, people are looking for a decent return with low or no risk. And the problem that we all have is that there's no such thing as a no-risk investment. There's no such thing as a riskless investment anymore, and that hasn't really been since the crisis started. So you've had this artificial suppression of interest rates. So interest rates throughout the Western world are at all-time low yields, not just in the context of a lifetime, but in the context of the last 5,000 years. So effectively, in all recorded history, rates have never been this low. The Bank of England said as much quite recently, a report by Andy Haldane. So if you accept that the risk-free rate is effectively giving you nothing, it's giving you no yield whatsoever, then you should, I think, have a nuanced view of where opportunities are. If everything is priced off the risk-free rate, and the risk-free rate is effectively zero or negative, don't expect huge future returns from anything. But what I do think makes sense in this really abnormal environment is to go for want of a better phrase, is to go for value. So I'd argue pretty much every part of the bond landscape is completely overvalued. It doesn't make any sense, completely overvalued. By definition, therefore, you're looking at equity risk, you're looking at listed businesses. But in the words of Ben Graham, who's the acknowledged sort of master of value investing, really comes down to two things. Firstly, don't buy poor quality assets, don't buy rubbishy businesses. that may appear as subjective call, but I think we can all agree, or to a greater or lesser extent, what a rubbishy business is. And secondly, when you've identified quality businesses, just don't overpay for them. So only buy quality businesses, quality listed franchises of good or exceptional management ability, but just don't pay too much for them.
Tim,
and again, we can agree what that is. Yeah. It's just not paying a premium price for these.
But this sounds like an almost impossible suggestion in a market like this, in that we know that almost everything is overpriced. We know the entire US market is overpriced. We know a lot of the European market is now, not nearly as cheap as it was. How on earth do we go out there and find this kind of value, good quality companies trading at reasonable prices in an environment where...
I think the answer is you have to go slightly further afield. You have to go the extra mile. I'd absolutely agree that there doesn't seem to be any kind of compelling value in the US. On the Schiller PE ratio basis, the US is something like 60% overvalued compared to its long-run average. So the US is clearly not a cheap market by anyone's means. UK and Europe, probably not so bad, but there are probably only pockets of value. As far as we're concerned, the only compelling value opportunity right now, these are opportunities in Asia and Japan. Japan is the one market that leaps out. There are other markets that are cheap, Russia, for example, but I don't think anyone would describe Russia as being a sort of a safe type haven. But Japan is an example where you've got this sort of strange convergence of factors. It's still the third largest economy in the world, but there are probably more Ben Graham-style value opportunities in Japan than there are in any other single market today. So they do exist, but you just have to look somewhat further afield for them.
And Japan also has its own QE program on.
And it doesn't hurt, exactly, it doesn't hurt, but that under Abe, you've now got one of the most aggressive monetary stimulus plans in the world occurring right now.
And a shift into equities by various institutions in Japan.
Including the government pension fund, correct. Yeah. So it's kind of like what's not to like about that
and
story.
This is an unusual situation, as you said earlier, across the world. Most pension funds are obliged to buy bonds, and more bonds.
Japan may be the only market where the government's actually trying to turn the supertanker around and say, guys, buy some more stocks.
And this makes sense, really. I mean, if over the long term we know that the returns from equities are pretty much always higher than the returns from bonds.
And also the Japanese debt to GDP ratio is just off the charts. There's a Texan hedge fund manager that I'm sure many of your readers will know called Kyle Bass, and he's described the Japanese government bond market as a bug in search of a windshield.
But Japan, if you look at traditional valuation methods in Japan, for example, if you look at PE, etc., it doesn't look that cheap.
Japan has always had a problem with shareholder value. There's a lot of businesses in Japan that are run, I think culturally they've been run for some time, and I'm sure you'll have seen this personally from your time over there. They're run for the benefit of employees, for stakeholders, if you like, but not for shareholders. Our sense is that that's slowly changing. But again, if you go, even in the context of the Japanese market, somewhat further afield, if you go more into kind of small and mid-cap territory, you'll find that we're finding managers who are investing into that area. There are plenty of opportunities where these companies are run more like a classic Western model. They're run for the benefit of shareholders, for shareholder returns, and it's not just paying lip service to that. They're genuinely delivering the goods. They're delivering, in some cases, record revenues. And the beauty of that market is that if you can find either the right business or the right asset manager who's investing into those businesses, if you can strike it lucky, you can buy shares of businesses that are generating all-time record profits, and you can buy them at low PE, single-digit price earnings ratios at 1x book or less. And these companies are not covered in some cases by a single analyst. This is what happens when you have a stock market that's been in a bear market for 25 years. There's no research coverage of a lot of these businesses. It's a fabulous opportunity.
Let's go back a bit to interest rates and the bond market. What changes this bizarre situation of historically low interest rates, of negative yields, etc.? What is it that might turn things around and have us see interest rate rises?
It's a good question, and I'd love to have the answer.
I'd love you to have the answer too.
Okay, well, I'll defer to somebody else, and I'll kick it into somebody else's back garden. Dylan Grice, the analyst Dylan Grice, I remember, we're talking about how long does this dysfunctional market last? And the reality, as he described it, he made a very fair point, I think. He said, you have to appreciate that, when you had the Soviet Union, you had a clearly dysfunctional non-market economy, a central planned economy, born in the chaos of sort of 1917, and pretty much every year objective international observers would have said, this cannot last. It's going to fall apart. It's going to break apart. So apparently the CIA every year was issuing research saying, it's any time now. It's going to break. And the reality is the Berlin Wall didn't fall until 1989. So the bottom line, if that metaphor is valid, and I'm sure it is, then this dysfunctional environment can outlive us. It can outlive all of us. However, I don't think it's as straightforward as saying, look, this really bad thing can be a bad thing for a lot longer than we think, because it's not just one country. It's most of the Western world. So I just simply cannot see how this doesn't get ultimately addressed by the market. We don't have a free market in anything at the moment. We have a centrally planned financial market system. So interest rates aren't set by a market, they're set by a handful of central bankers at artificially low levels. That means bond yields are artificially low. That in turn means that a lot of stock market investments are also artificially high, because everything's relative. What happens to break this, and you have maybe bond market vigilantes or stock market vigilantes come back onto the scene? Maybe it's some form of market dislocation, some kind of crash. There's a perception that central banks have got everyone's backs, and I just think that's a very dangerous delusion. I think this comes down to a battle royal between governments, because that's effectively who central banks are working for, and the market. And I happen to think that over time the market will prevail, but it may take some time.
And what about the debt situation? I mean, it's very hard to see how governments, even in this incredibly low interest rate environment, and even if it does go on for some time, how they resolve their public debt situation. I mean, in the UK, for example.
I'm not sure they can. I'm not sure they can. So, I mean, as a former bond salesman, the way I see this is you've only got three outcomes. One outcome is that you have enough economic growth to service a clearly unsustainable debt burden. I think in the Eurozone, that's just not going to happen. We're too far gone for that in Europe. So let's discount that.
So we have to expect default.
So then you've got option 2 or option 3. Option 2 is default. Option 2 is default or repudiation, or if you want to be polite, restructuring. Maybe we get some form of that. The third outcome, though, and this is the one that I think is most likely to happen, is the one that also governments throughout history have resorted to, and it's inflation. Now, clearly, we don't have that yet. Everyone's talking about deflation.
But governments have been attempting to create inflation.
But governments have been attempting to trigger inflation. So I'm just minded to think that given enough time and given enough, lack of political will to impose the economic restructuring that's desperately required, in the absence of that, to fill that political vacuum, central banks will step in, and if you thought QE thus far was aggressive, we'll get a load of what may be to come. Deflation effectively is game over for indebted governments. So on that basis, I think at some point, this thing does turn around, and in response to perhaps quite alarming levels of deflation, the central banks go all in and then some, and then wait to see what the inflationary outlook suddenly looks like.
Okay, so the more deflation we get now, the more inflation we're likely to have later.
That strikes me as a very fair.
I mean, there is a view that QE is actually deflationary, not inflationary, in that by keeping interest rates very low, by bailing out zombie companies, etc., it keeps supply much higher than it would be in an ordinary market or a free market. So the more QE you have, to a degree, the more deflationary it is rather than inflationary.
There may be something to that. I mean, I'm not an economist, and I'm glad that I'm not an economist, but I remember meeting a Japanese fund manager back in 2000 or 2001, and I'll never forget what he said. He said, up until now, Japan has been the dress rehearsal, the rest of the world will be the main event. Now, at the time, that's 15 years ago. Now, at the time, that seemed an absurd thing to say. With the benefit of 14 years hindsight, it doesn't look so absurd anymore. The Japanese have clearly been trying and doing everything in their power to try and get their economy back on its legs. They've been in the wilderness for well over 20 years, and they are where they are now. It does rather feel like pretty much all of the West has sort of tripped gaily along behind them, going, well, let's try and make our economies a bit more like Japan. And so far, they seem to be succeeding.
Okay, so as far as you're concerned, the only answer in this environment is to look for value. The value that you see is in Japan. What about holding cash? In a deflationary environment, cash seems like the obvious place to go.
Cash, I think, has a role. There's clearly problems over the solvency or the creditworthiness of the banking system. So for my money, if you incorporate gold as part of that cash, then I'd absolutely concur. And the problem with gold is it's a very misunderstood asset. I mean, I've made no secret of the fact I think gold has a lot of value as a portfolio insurance, portfolio defense, inflation hedge, catastrophe hedge, if you like. But I think gold is a misunderstood asset. And the best way I've heard gold described by people far more intelligent than me is gold isn't even an investment. It is, quote, a conscious decision to refrain from investing until you have an honest monetary system. And I think there's a lot of wisdom and truth embedded in that statement. It could be a long, long time. But ideally, we get that, that system reset quite soon. And it feels to me like we are going to get it quite soon. The idea that you've got all these bonds, government bond markets trading with negative yields, this feels to me like we are much closer to the end of a 30-year plus bull run in interest rates and in credit. And ideally, we get some form of, let's not scare the horses, we get some form of correction to that credit bubble. I don't think it's going to be pretty, so clearly choose your credit exposure with care, choose your bonds with care, but ideally that situation does get resolved somehow, possibly by a combination of economic growth and restructuring and inflation, ideally all three, because any one in isolation is problematic if it's not growth. But this feels to me like we must be surely closer to the end game now, and that's good news.
Are you still holding a lot of gold in your own portfolio?
Yes.
How much?
It's a lot. I mean, it's a lot. It's more than I would advocate any other person or entity held. But no, I'm perfectly relaxed because I'm playing a long game.
So the average person, how much gold do you think they should be holding in their portfolio?
I think for any asset, you need to have, in the interest of true diversification, you need to be at least, say, 10% committed. Otherwise, it's meaningless. It's completely marginal. So depending on people's appetite, risk tolerance, requirement for income, I'd say anything from 10 to maybe 25, 30% is prudent. It'll look more prudent if the price clearly starts to recover. And I sense that we may be so close to some kind of a low. Everybody hates this thing. So, just from a contrarian perspective, now is probably not a bad time to be buying either gold or gold miners.
Brilliant. Tim, thank you very much.
Thank you.
Cash is actually going to be a very good investment because under deflation, the value of cash goes up every day. And the other thing about this, what we're looking at today, people who remember 1973 and the oil price shock of the Arab oil boycott, that was the day almost, those few weeks where people suddenly got the idea, what I ought to do is I ought to borrow as much as possible and I ought to buy as quickly as possible.